Usually, when you picture a legacy oil and gas company, you probably picture something straight out of a history book, right? Like massive steel rigs, roughnecks in hard hats, guys poring over paper maps on the hood of a dusty pickup truck.
Yeah, exactly. It's a very physical, visceral image. I mean, it's dominated the public imagination for, what, a century now?
Right, at least a century. It just feels entirely industrial. Like it's all about brute force, diesel engines, heavy machinery, just trying to strike black gold.
We definitely tend to think of it as a purely mechanical enterprise. Mm-hmm. Steel goes into the ground, pumps move up and down, crude oil comes out.
Yeah.
It's viewed as a highly tangible, almost binary operation.
Right.
You either find the oil or, well, you don't.
But what if I told you that one of the biggest names in the energy business is currently running hundreds of multi-million-dollar wells using an autonomous, firewalled artificial intelligence?
Oh, wow.
Yeah. An AI that is literally writing its own code to optimize the physics of extraction in real time, and doing all of this without a human ever touching a single dial.
I mean, that completely shatters that traditional picture. Suddenly, you aren't really looking at an oil driller anymore.
Exactly.
You're looking at a highly sophisticated technology and data company that just happens to produce energy as its end product. It fundamentally changes the math on how you evaluate their operations and, their future value.
And the crazy part is, we actually have the data to prove that this isn't just theory. Welcome to our latest deep dive. Today, we are breaking down the Q1 2026 Devon Energy earnings, call ticker symbol DVN.
And for those of you listening who follow our Talk Tickers format, you know our mission here.
Right. We want to take the Wall Street jargon, the dense technical engineering terms, all that complex financial maneuvering, and translate it into actionable analysis for your portfolio.
Plain language, data forward, and totally actionable. We're going to look at the hard numbers, the operational story driving those numbers, and management's forward guidance.
Which, by the way, includes a massive mega merger closing literally tomorrow. So if you're holding DVN, considering a position, or just trying to understand the energy landscape, stick around.
The first quarter data is really the perfect place to start, I think, because it immediately illustrates that gap between the old school perception and the modern reality.
Let's hit the headline numbers then. What are we looking at?
So Devon reported oil production reaching 387,000 barrels per day.
Wait, 387,000 just in oil?
Just oil. And that hit the absolute top end of management's guidance range for the quarter.
Putting that into perspective for a second, 387,000 barrels a day is a logistical mountain. I mean, you don't just achieve the top end of your guidance by asking the guys on the rig to swing their hammers faster,
No, absolutely not. But honestly, the production number isn't even the most surprising part of the report.
Really? What is?
The truly eye-popping metric is that their capital spending came in 6% below the midpoint of their guidance.
Okay, wait. 6% below budget.
Yep. Which is incredibly rare in the exploration and production space. Usually, if an operator wants to push production to the absolute limit, they have to overspend.
Right, because you're paying overtime, running rigs harder, buying more material.
Exactly. They have to pay more for steel casing or incur higher logistics costs, whatever it takes. So to produce more volume while simultaneously spending 6% less capital, that indicates a structural change in how they're putting holes in the ground.
And all of that translated into $816 million in free cash flow for a single quarter.
Massive number.
It is, but let's actually define that term before we go any further, because free cash flow gets thrown around constantly on financial networks. For an independent producer like Devon, what does that number actually represent in plain English?
So free cash flow is basically the ultimate measure of corporate health. It is the cold, hard cash left over after a company has paid for all of its daily operating expenses.
Like salaries, leases, electricity bills.
Right, exactly. All of that, plus all of its capital expenditures. And capital expenditures, or CapEx, is the money required to maintain or grow the physical assets, which in this industry means drilling and completing new wells.
Okay, got it.
So that $816 million is truly free cash. It can be handed right back to the shareholders in the form of dividends or stock buybacks, or they can use it to retire debt.
Okay, so generating almost $1 billion in free cash while cutting your spending by 6% is a pretty neat trick. But I have to play devil's advocate here for a second.
Sure, go for it.
We've seen a remarkably strong commodity market recently, right? Oil prices have been higher than almost anyone modeled coming into 2026. Isn't it possible they just caught a lucky wave? Like a rising tide lifts all boats, so maybe Devon is just surfing a macro commodity cycle that they have absolutely zero control over.
Well, the commodity tailwind is undeniable, I'll give you that. And management explicitly acknowledged on the call that the pricing environment was meaningfully stronger than they underwrote.
Okay, so they admitted it helped.
They did. But here's the thing. Higher oil prices only inflate the revenue side of the equation.
Oh, right.
A global oil rally does not explain a 6% drop in your internal capital spending. If anything, when oil prices spike, the cost of services usually goes up.
Oh, because everyone wants to drill at the same time.
Exactly. Rig rates, pressure pumping crews, sand, steel, all of that gets more expensive because every operator is rushing out to drill and cash in on the high prices.
So the fact that their costs actually went down in an inflationary service environment is the real signal here.
Precisely. That 6% drop proves the financial discipline is internal. It's not just a market gift. It's a direct result of drilling and completion efficiencies. They are basically getting faster at drilling the laterals, and they're using fewer days on location to stimulate the rock.
And because they are generating so much pre-tax income from this extreme capital efficiency married with higher oil prices, it actually created a really fascinating quirk in their tax situation for the quarter.
Yeah, I noticed that too.
Yeah, I caught that during the Q&A portion of the call. An analyst pointed out a sudden shift in their cash taxes. They had this massive flip from deferred taxes to current taxes, and management guided that their cash tax rate will step up to around 10% in the back half of the year.
Right, which sounds bad, but it's basically the ultimate rich person problem.
How so?
Well, the U.S. tax code allows oil and gas companies to deduct intangible drilling costs to shield their income. It's a huge incentive. But Devon is so profitable right now, and their wells are paying out so quickly that they are burning through those historical tax shields much faster than anyone anticipated.
Oh, wow. So they're just making money too fast for their old tax deductions to cover it.
Exactly. On a standalone basis, they are entering the second quarter with significant upside torque to their free cash flow, even with that 10% tax rate factored in.
So we have a pretty clear picture of the outcome, right? More oil, less cost, accelerating tax liabilities due to massive profitability. But the mechanics of how they actually achieved a 6% drop in CapEx is what really demands our attention.
Definitely. The how is the best part of the story.
Yeah, because just over a year ago, CEO Clay Gaspar and the management team set this highly publicized goal to achieve $1 billion in what they called business optimization.
Which, by the way, was met with intense skepticism across the industry.
Oh, totally.
Well, during the Q&A, an analyst actually congratulated Gaspar on hitting the milestone early, noting that most of the market doubted an operator could just, pull $1 billion of sustainable incremental value out of thin air.
Yeah, usually a company masks a target like that by executing some major acquisition and claiming synergies like, oh, look, we fired half the accounting department. There's our optimization.
Exactly. It's usually smoke and mirrors. But Devon did it organically, and they did it well ahead of schedule.
And the engine behind this $1 billion savings is what we briefly touched on in the beginning, ChatDVN.
Right.
They have been quietly running this fully firewalled internal AI tool for 3 years. But look, let's be real. Every company on Earth is slapping the letters A and I on their earnings calls right now to juice their stock price. Are we seriously supposed to believe a legacy oil company built a real neural network, or is this just a glorified Excel macro that parses rig data?
It is far, far more sophisticated than a simple data script. They've categorized their AI integration into distinct waves, which I think shows how seriously they've approached this.
Okay, walk me through the waves.
So wave one, which started years ago, was the unglamorous work of data architecture. It was taking decades of fragmented geological logs, drilling telemetry and production histories, and basically formatting them so a machine learning model could actually ingest them.
Right, because if the data is messy, the AI is useless. Garbage in, garbage out.
Exactly. You can't train an AI on PDFs and scribbled notes. But they are now deep into wave two, where the AI is performing heavy computational lifting. They are leveraging ChatDVN to literally write code for proprietary internal applications.
Wow.
And more importantly, they are using it to translate massive real-time data flows from the drilling rigs into actionable intelligence.
Give me an example of that. What kind of data?
Well, think about it. When a drill bit is 2 miles underground and moving horizontally through solid shale, it generates terabytes of telemetry. We're talking vibration, torque, weight on bit, gamma ray readings, all of this streaming back to the surface constantly.
And historically, a human engineer would have to stare at those squiggly lines on the screen and make like gut-feeling decisions about how to adjust the rig parameters, right?
Exactly. It was highly dependent on the experience level of the guy sitting in the trailer. But now the AI model is analyzing that telemetry instantly. It's comparing it against the historical data of thousands of offset wells, and is providing the drilling engineer with optimized parameters to cut days off the drilling time.
Okay, so that right there is the direct mechanical link to the 6% drop in capital costs. Faster drilling equals less money spent on rig rentals.
Yep, you hit the nail on the head. But wave 3 is where the story shifts from just cost savings to actual revenue generation. This involves redesigning processes from the ground up with AI at the center, specifically in autonomous operations.
Yeah, this is the part that sounds like science fiction to me. Management stated they now have over 850 wells running on fully autonomous smart gas lift, and they are seeing a 2 to 3% production uplift.
It's incredible.
But I need to understand the physics here before I just blindly believe the financial claim. Because I know that oil doesn't just shoot out of the ground forever like a geyser in a movie, you know. Eventually, the natural pressure drops. So I assume gas lift is a way to force the oil out. But how does AI optimize a physical pump?
Well, let's clarify the physics first, because gas lift doesn't actually use a physical mechanical pump at the bottom of the well.
Oh, really? I always pictured like a plunger.
No, it's actually much more elegant. Imagine blowing bubbles into a straw that's sitting in a glass of water.
Okay, got my imaginary straw and water.
As you blow air into the straw, the bubbles mix with the water inside it, making that fluid lighter than the fluid outside the straw.
Right, because air is lighter than water.
Exactly. And that reduction in density allows the water to rise up and flow over the top of the straw.
Okay, so the gas bubbles aerate the liquid column. I'm with you.
That's the exact principle used in the oil field. In an oil well, the natural hydrostatic pressure of the reservoir fluid is heavy. When the formation pressure depletes over time, that heavy fluid column just stops moving to the surface. It gets stuck.
Makes sense. So what do the engineers do?
They inject high-pressure natural gas down the casing, which is the outer ring of the pipe, and it enters the inner production tubing through these small valves. It mixes with the oil, lightens the hydrostatic weight of the column, and suddenly the remaining natural reservoir pressure can push that lighter mixture to the surface.
Okay, that makes perfect sense physically. But if it's just a matter of pumping gas down a pipe, why is manual gas lift so inefficient? Like, why do you need an artificial intelligence for this?
Because the dynamics of a well change constantly. The mix of oil, water, and natural gas coming out of the rock fluctuates literally minute by minute.
Oh, so it's not a steady stream.
Not at all. If you inject too little gas, the fluid column stays too heavy and production stalls out. But if you inject too much gas, you actually create friction in the pipe, choking off the flow entirely. Plus, you're wasting the compressor energy required to pump the gas down there in the first place.
Sounds like a really delicate balancing act.
It is. And historically, an engineer would drive out to a well, look at yesterday's flow data, adjust a valve manually, and basically hope for the best.
It's essentially guessing. You're always reacting to old data.
Exactly. What Devon has engineered here is a closed loop, physics-based calculation powered by AI. The sensors on the wellhead feed real-time pressure and flow data into the model. The AI recalculates the optimal gas injection rate continuously and automatically adjusts the choke valves on the surface.
Oh, wow. So it is literally a smart thermostat. But instead of regulating temperature in a house, it is regulating the multi-phase fluid dynamics of a multi-million-dollar asset.
That's a perfect analogy.
Yeah.
And they were applying this across 850 wells simultaneously.
It's like a hive mind. Wait, if the AI learns something about pressure anomalies in one well, does it immediately apply that instinct to the other 849 wells?
That is the beauty of a centralized model. The machine learning algorithm gets sharper with every single barrel produced across their entire Delaware Basin network. They piloted this back in 2025, right? And they were aiming for a 2 to 3% uplift. Now that it's rolled out to 850 wells, management noted the current uplift is actually exceeding the initial pilot phase.
Which is huge, because that means they're pulling more oil out of the ground without spending a single dime on drilling rigs or frac crews. I mean, eking out 3% more production across 850 wells via software. That is pure margin expansion.
Exactly. It requires virtually zero capital expenditure compared to punching a new hole in the ground.
Yeah.
And they aren't stopping there. They're aggressively expanding this. The new target is 1,500 wells.
Wow. Almost doubling it.
Yep. And they are actively testing AI models on other forms of artificial lift that do involve mechanical pumps.
Like what?
like ESPS, electrical submersible pumps, and traditional rod pumps. The AI basically monitors the power draw. It identifies wells that are draining too much electricity or operating below their optimal frequency, alerts the engineers, and they instantly capture the production bump while saving on electricity costs.
It's just a compounding effect of marginal gains everywhere you look. But, operational efficiency wasn't the only lever they pulled this quarter. We also really need to look at their market savvy, because they navigated a very tricky landscape in the Permian Basin, specifically regarding natural gas pricing.
Yes, the marketing team executed a brilliant defensive strategy here. We have a highly unusual situation right now in the energy markets, where Waha gas prices, which is a benchmark for natural gas physically located in West Texas, have actually gone negative.
Okay, wait. Let me follow that logic for a second. Negative prices mean the producer is paying someone to take the gas off their hands?
Yes.
How does a commodity reach a negative value? Why not just burn it off?
You're referring to flaring. But strict environmental regulations, and frankly, Devon's own corporate emissions targets, place hard limits on how much gas can legally be flared into the atmosphere.
Okay. So burning it isn't a viable out, but why is it negative in the first place?
To understand the negative pricing, you have to look at the geology of the Permian Basin. The Permian is primarily an oil basin. Operators are there for the crude. But as you extract the oil, a massive amount of what is called associated gas comes out with it.
Right, because the pressure drops as the fluid hits the surface, and the natural gas literally bubbles out of the oil, like opening a soda can.
Exactly. The thermal maturity of the Permian rock means oil and gas coexist in the reservoir. So the industry is drilling aggressively to capture high-priced oil, right? Oil's doing great. But as a byproduct, they are producing a tsunami of natural gas. And the physical infrastructure, meaning the pipelines required to move that gas out of West Texas and get it to the Gulf Coast or Mexico, is completely maxed out.
There's too much supply and not enough pipes, and you can't just vent it into the atmosphere, so you're trapped.
You are totally trapped, and the buyers know it, which drives the local price below zero. But Devon has the portfolio strength to play defense here. Their strategy in a negative price environment is surprisingly simple. They proactively shut in their highly gassy wells.
Okay, what does that mean exactly?
They evaluate their portfolio based on the gas-to-oil ratio, or GOR. The wells producing the highest ratio of gas relative to oil are simply turned off temporarily.
That feels totally counterintuitive to an energy investor who always expects maximum volume at all times. But if you think about it, it's actually the most rational economic decision. The cheapest storage facility on Earth is the ground the gas is already sitting in. You just leave it trapped in the shale until the infrastructure catches up.
Precisely. And management is waiting for the Blackcomb pipeline to come online later this year.
Right, the new pipe.
That pipe will provide massive takeaway capacity, which will alleviate the local bottleneck and allow them to sell all that stored gas at a premium. So by managing these strategic shut-ins and utilizing financial hedging instruments, they have limited their exposure to those negative Waha prices to roughly just 10 to 15% of their total gas volumes.
It's literally a masterclass in optimization. They are crushing capital costs, they're using neural networks to squeeze margins out of legacy wells, and they're navigating pipeline bottlenecks without taking a financial beating.
Yeah, they're firing on all cylinders.
But all of this, as impressive as it is, feels like the warm-up act. Like the real focal point for anyone evaluating the stock right now is the mega merger.
Oh, absolutely. The catalyst that will define the next decade for Devon is their merger with Cotera Energy. The shareholder votes for both companies passed overwhelmingly on May 4th, and the transaction officially closes tomorrow, May 7th, 2026.
Tomorrow, that's huge.
This combination creates an absolute juggernaut in the U.S. independent exploration and production sector.
And management laid out some pretty massive expectations for this, right? They announced a stated synergy target of $1 billion. But then Clay Gaspar explicitly told analysts on the call, the $1 billion synergy target is the floor, not the ceiling.
Bold words.
Yeah, and I have to push back here, honestly. The history of M&A in the oil patch is completely littered with value destruction. When two giant energy companies merge, you usually get a massive mess of redundant middle management clashing corporate cultures and this terrible period where field efficiency just plummets because no one knows whose drilling protocols to follow. How is this not just another CEO empire-building exercise?
Well, that is the historically accurate, highly skeptical view, and it's a fair point. Many oil and gas mergers fail to realize their promised synergies because, frankly, they underestimate the friction of combining disparate IT systems, supply chains, and field cultures.
Right. It's easy on a spreadsheet, hard in the mud.
Exactly. But Gaspar actually addressed this head-on during the call by referencing Devon's previous transformative merger with WPX Energy a few years ago. He was remarkably candid. He admitted that after the WPX deal was signed, the executive team literally looked at each other and said, okay, what do we do now?
Oh, wow. So they bought the assets and then had to build the airplane while they were flying it. They had no framework to actually track the savings they promised Wall Street.
Exactly. They learned that lesson the hard way. But the Cotera integration is fundamentally different because the architecture is already built. Devon is taking the exact same business optimization playbook that just successfully stripped $1 billion out of their legacy operations, and they are dropping the Cotera assets right into that existing machine.
Okay, that changes things.
Yeah. As of the morning of the earnings call, the integration teams had already identified 156 distinct value capture opportunities.
And they put Trey Lowe, their chief technology officer, the guy who led the internal AI and optimization project, in charge of co-leading the Cotera integration.
Which is brilliant.
It is a massive signal to the market. You have the tech visionary, not just a traditional operations guy, overseeing the physical merger of the assets.
It completely changes the paradigm. The tracking software, the accountability structures, the cultural mandate of data-driven efficiency, it is fluent on the Devon side. And when you look at the industrial logic of the assets themselves, the overlap is extraordinary, particularly in the Delaware Basin, which is obviously the crown jewel of the Permian.
Let's talk about the Delaware Basin, because that's where the math gets really interesting. Management pointed out that over the last 10 years, they have replaced almost 100% of their consumed inventory just through appraisal and downspacing in the Delaware.
That's a huge metric.
It really is.
Right.
Let's unpack downspacing for the listener, though, because to a layperson, it sounds like just cramming more wells into a smaller area. But the subsurface engineering is actually incredibly risky, isn't it?
Oh, downspacing is the holy grail of capital efficiency, but it is fraught with technical peril. The goal is to drill horizontal well bores closer together to extract more oil from the exact same surface acreage to try to maximize your real estate. However, when you hydraulically fracture a well, you are creating massive pressure networks in the rock. If you drill a new well, what we call a child well too close to an older parent, well, the fractures can communicate.
So you get what's called a frac hit.
Exactly.
The pressure from the new well basically blows into the old well, and you end up ruining the production profile of both. You essentially spent $10 million to steal your own oil.
Precisely. It's a disaster when that happens. So to successfully downspace without causing destructive interference requires immense subsurface data, highly predictive modeling, and absolute precise control over the fracture geometry.
Which loops right back to the tech story.
Exactly. Because Devon has integrated AI into their completion designs and driven their costs so low, they can afford to experiment with tighter spacing models. They are effectively manufacturing new drilling inventory out of dirt they already own.
And third-party engineering estimates already push Devon's drilling inventory well beyond 10 years, right? So folding in Cotera's acreage only extends that runway even further.
Oh, absolutely.
Yeah.
But management also signaled they aren't going to be sentimental about this newly combined portfolio. They're adopting a ruthless blank slate approach.
Yeah.
The exact phrase they used was, every asset must earn its seat at the table.
I love that quote. If you are a retail investor, that is exactly what you want to hear. You don't want an executive team falling in love with a piece of dirt just because the legacy company operated it for a decade. If it's a drag on the corporate margin, sell it to a private operator and redeploy the cash.
Exactly. No emotional attachments.
And speaking of cash, the guidance on shareholder returns is incredibly aggressive. Let's hit the bottom line numbers for the investors listening.
The financial signals here are just massive. First, subject to formal board approval post-close, Devon is raising the base dividend by over 30% on a per-share basis starting in the second quarter.
A 30% bump.
Yeah, in a volatile commodity sector like oil and gas, a 30% structural jump to your dividend is a profound display of confidence in the durability and really the downside protection of your free cash flow.
And then you add the buybacks into the mix. Both Devon and Cotera actually paused their share repurchase programs during the regulatory waiting period between the deal announcement and the close. So while oil prices were unexpectedly surging in Q1, they were essentially legally forced to just stockpile all that cash.
Which means they're entering this post-close integration period sitting on an absolute mountain of liquidity. Management explicitly stated that the repurchase program will resume immediately tomorrow.
That's going to be a huge catalyst.
Furthermore, they are positioned to increase buyback activity significantly beyond their legacy levels because they believe the combined company's equity is trading at a steep discount to its intrinsic optimized value.
Let's pull all these threads together then. For the retail investor listening to this Talk Tickers breakdown, what is the actionable bottom line here?
Honestly, the verdict is highly bullish, but it requires a shift in how you evaluate the company. If you hold or are considering the stock, Devon is offering an incredibly compelling cash flow story today. You have the combination of greater than 30% dividend increase, a massive stockpile of cash ready for aggressive buybacks, and a hyper-efficient, AI-driven cost structure that protects margins even if oil prices decide to retrace.
But the investment thesis entirely hinges on execution, doesn't it? The primary risk to monitor isn't necessarily a crash in oil prices, it's the operational risk of the merger itself.
Right.
Because it is one thing for Trelo to identify 156 integration points on a spreadsheet, it is another thing entirely to execute them out in the Permian dirt without a hiccup. The market is going to deeply scrutinize their Q3 and Q4 capital efficiency to ensure the Cotera assets are actually absorbing the Devon software optimization.
Without a doubt, execution is everything here. And because they are generating such immense free cash flow, capital allocation discipline becomes paramount. Do they pay down the debt incurred from the merger? Do they accelerate the buybacks? Or do they direct capital toward new alternative ventures?
Which actually brings up a fascinating tangent from the earnings call. It was a brief update, but I think it speaks volumes about their long-term vision. Management provided an update on Fervo Energy.
Right, Fervo.
For those who don't know, Fervo is a private startup pioneering next-generation enhanced geothermal systems, or EGS. They just recently filed their S-1 to become a publicly traded company, and Devon Energy was the lead investor in their Series D funding round.
Now, at first glance, a retail investor might look at that and just scratch their head. Why is a massive oil and gas driller completely obsessed with optimizing shale extraction, throwing millions of dollars at a renewable geothermal company? It seems like a distraction, honestly.
It totally seems like a distraction until you understand the underlying science of enhanced geothermal systems. Because traditional geothermal energy requires three things to occur naturally: heat, underground fluid, and permeable rocks. The fluid can flow to the surface. That naturally limits traditional geothermal to very specific volcanic regions like Iceland or parts of California.
Right. Nature has to provide all the ingredients. EGS, however, doesn't wait for nature to provide the permeability.
Exactly. Fervo is drilling into hot, completely impermeable granite, and they are creating the permeability themselves. And how do they do that? By using the exact same horizontal drilling and hydraulic fracturing technologies that the shale oil industry perfected over the last 15 years.
So the synergy is absolutely perfect. I mean, think about it. Who on earth is better at understanding complex geoscience, steering a drill bit horizontally 2 miles underground, pumping fluid at extreme pressures to fracture solid rock, and analyzing the resulting subsurface telemetry than an elite Permian Basin shale driller?
No one. They literally wrote the playbook. Devon is taking their core competencies, the physics of drilling and completion that ChatDVN is currently optimizing, and applying them to a completely different energy sector. They aren't just writing a check here. They are actively sharing operational data and technical expertise to help Fervo scale their geothermal wells.
And this isn't just an ESG play to feel good about green energy and score points in a press release. Management was remarkably candid on the call. They stated that when they made the initial investment in Fervo, the one macro factor they drastically underestimated was the absolute explosion in demand for firm, always-on, 365-day baseload power in the United States.
Yeah, because the electrification of the economy, the transition to EVs, and most importantly, the massive, insatiable power demands of data centers required to run global AI infrastructure are just straining the grid to its breaking point. Solar and wind are intermittent, right? They require massive battery storage. Geothermal provides constant zero-carbon baseload power.
It's a brilliant hedge. Devon is utilizing AI to hyper-optimize their legacy oil production today, while simultaneously investing the profits from that oil into the exact baseload power source needed to run the AI data centers of tomorrow.
Mind-blowing.
It really is. And they are reaping the financial rewards as Fervo heads toward the public markets.
It just demonstrates a rare entrepreneurial DNA. They aren't behaving like a legacy industrial company content to just milk a depleting asset base until the lights go out. They are actively extrapolating their proprietary data and physical skill sets into high-growth, next-generation sectors.
So if we look back at the entire landscape we've covered today, from the complex fluid dynamics of gas lift in the Delaware Basin to the negative pricing mechanics of associated gas to a massive M&A integration spearheaded by a chief technology officer, it completely redefines what this company is. What we are witnessing is the transformation of a 55-year-old exploration and production company into a tech-enabled cash machine. They aren't merely surviving the whims of global commodity cycles anymore. They are structurally altering the economics of extraction.
And that leaves me with a final provocative thought for everyone listening. We started this deep dive talking about the traditional perception of an oil driller, the dirt, the steel, the brute force. But if Devon is running firewalled neural networks that write their own code to autonomously regulate well head pressures, and if they are applying their subsurface data analytics to unlock the grid-scale geothermal power of the future, our retail investor is making a massive mistake by continuing to price this stock using legacy valuation models.
It's the multi-billion-dollar question.
Right. If the core engine driving the margin isn't just the drill bit, but the proprietary machine learning algorithm guiding it, shouldn't the market start valuing Devon's data infrastructure and tech capabilities rather than just treating them like a cyclical industrial stock? Because if we are still judging them by the old metrics, we might be entirely missing the actual engine of their future value. Food for thought. Thanks for joining us on this deep dive.